Alright, hello everyone, and welcome to a very special request that someone had to go through basically how to approach 8-marker exam questions, which historically have popped up very randomly on VCAR exams. There was 2 back-to-back in 2017, there was 1 in 2018, then we haven't had one since. Hopefully VCAR aren't the jerks that we know that they are, and they don't put one on this year's exam, but we're going to talk through how to approach them, why they're not actually as scary as they seem, and basically some of the strategies and tips to write a great 8-mark answer. So some general advice here. Historically, 8 marks questions in the VCE economics have just been 2 4-mark questions smushed together. It's just like 1 4-mark question, and then it's like, oh, we want to ask about this too, and then just put them together, and then that's all it really is. So if you split it up and answer it as 2 separate 4-mark questions, it makes it a lot less scary. It makes it a lot easier to see when the mark allocation should be and plan your answers out. Because if you just look at it as 1 full 8-mark question, you're going to start worrying that you're going to write an essay, and that's going to just lead to missing out on things. If a question asks you for aggregate demand policies, which has come up a few times, that means VCAR expects you to talk about both budgetary and monetary policy. So make sure you're aware of that and prepared to do that. And you can only get the highest possible marks then if you do both of those things. Also, if a question asks you about the stance of monetary or budgetary policy, then expansionary or contractionary needs to be stated. So you need to say either expansionary, contractionary, more expansionary, less contractionary, etc. So let's look into some examples here. So first up, 2B from 2018, we're going to look at 2 examples in total. Monetary policy influences aggregate demand and the wider economy via transmission mechanisms. Imagine the Reserve Bank of Australia increased the cash rate from 1.5 to 2%, and explain how 2 monetary policy mechanisms have operated to affect the level of aggregate demand and the rate of economic growth under those conditions. So when we look at this question, obviously there's a little bit to it. There is the increase of the cash rate that you need to talk about. You'd probably want to talk about why they might be doing that for your first kind of mark. So that's pretty important. Like, that's setting the scene why they might do that. Then you're going to get 3 marks for each transmission mechanism. So 1 transmech, how that impacts aggregate demand. So you talk about how it impacts the components of aggregate demand, then how it impacts aggregate demand overall. That's going to get you your next 3 marks. So you're going to give a short description of that transmission mechanism, how an increase in the cash rate impacts that transmission mechanism and the component of aggregate demand, and then how that impacts aggregate demand overall. That's going to get you your next 3 marks. Then you're going to do the same thing with another one. And then you get your final mark for linking them both. The rate of economic growth. And that is going to get you the 8 marks overall. So we're going to look at VCAR's, a couple of VCAR samples for this. VCAR was actually really generous in this question and gave a sample for every single transmission mechanism, which they rarely do. I always highly recommend find the transmission mechanisms that work for you and use those all the time, because VCAR have never specifically stated transmission mechanisms. Watch as they now do that and make you do 2 specific ones, but they've never done that before. You've always been able to choose what you want to do. So if we want to look at a sample, and this is massive, but if we look at where the first mark is, so if the RBA raised the cash rate, this would signal a tightening of monetary policy, a move to a more contractionary stance. This would suggest that the RBA was concerned about the emergence of some inflationary pressures and wished to raise the interest rate to curb these pressures. This is aimed to slow down aggregate demand pressures and the rate of economic growth, although a 2% cash rate is still a relatively low level. That's a lot for that first mark. Also, a thing worth highlighting is that a lot of students pointed out that a cash rate of 2% was still technically expansionary, just less expansionary. I think that's great. That's the best possible way you could answer that. So the cost of credit channel is a transmission mechanism through which changes in the rate of interest rates affect the cost of credit and therefore the wider economy. For example, an increase in the cash rate causes interest rates to rise, and therefore it costs businesses more and households more to borrow. This discourages households from borrowing and encourages them to save more. And this discourages businesses from borrowing to invest. Both of these reduce aggregate demand and therefore inflationary pressures. The cash flow channel is a mechanism through which the cash rate and interest rate changes the level of repayments on loans for those with existing variable rate home loans. That's the really important part with the cash flow channel. Credit cards, etc. You don't need all those things in brackets. For example, when monetary policy is tightened, borrowers experience a decrease in the amount of discretionary income available. That's the important part there, as they allocate more of their disposable income to servicing existing loans. This reduction in cash flows affects the willingness and ability of households and businesses to spend on consumption and investment. There you go, covering the key components of aggregate demand, and thus aggregate demand and inflationary pressures are reduced. Low levels of aggregate demand would result in a buildup of unsold stock, signaling businesses to cut production and therefore resulting in a slowdown in the rate of economic growth. And there is the final mark. So you got your 3, 3, and then 1 at the end for your 8. So it's not too bad when you break it down like that. When you break it down into those little components, it's a lot simpler to get through overall. Now we look at one more from 2017. So evaluate one strength and one weakness of using each budgetary and monetary policy at achieving increased jobs and growth. So there's a lot to break down there. So obviously you've got to do, there's going to be 4 marks on budgetary and 4 marks on monetary. You got to do one strength and one weakness, and you got to link it to unemployment and economic growth. So there's a lot in there. So what you're going to end up doing is breaking down. You're probably going to describe budgetary policy, the scribble apparently. I'm going to get rid of that because that's terrible to have in there. Describe budgetary policy. You're going to need one strength. And so you need a little bit for saying what the strength is, but you have to tie that into jobs and growth. So strength linked to jobs and growth. So how that strength then creates jobs or improves growth. Then you do the same for a weakness, how it kind of may limit the impact on jobs and growth. And that would be your first part. So it'd kind of be describing budgetary policy you wouldn't really get anything for, but you'd obviously want to do that to set the scene. Then you get 2 marks for your strength tied to jobs and growth and 2 marks for your weakness. Then you do the same for monetary policy. So it'd be the exact same thing, except you do monetary policy, strength linked to jobs and growth, and then weaknesses tied to jobs and growth. And then that would get your 8 marks overall. So we're going to look at budgetary policy on one slide and then monetary policy on the other. One thing of note is that this is an evaluate question. And usually in an evaluate question, you'd go strengths and weaknesses, then come to a conclusion at the end. In terms of what VCAR was providing for this, they didn't really need a conclusion at the end, which is weird for me. I would include that, saying how well they've been able to do that. But because it hasn't been recent budgetary monetary policy, there was no real endpoint to make, because it's just like one strength and weakness from the theory about how well they can achieve jobs and growth, not how they've been able to do it right now. So because it hasn't been talking about how to do it right now, there's no real need for a conclusion at the end about how well they've been doing it. So let's look at budgetary policy. So budgetary policy is an aggregate demand management tool which involves the government altering the composition of revenues and outlays. One strength of budgetary policy is that in achieving increased jobs and growth is that it has a short impact lag, which means that when changing policies are implemented, they can very quickly impact aggregate demand, the unemployment rate, and economic growth. For example, the $1,080 tax offset for low and middle income earners increases the discretionary income of households, which would lead to an increase in private consumption spending once implemented very quickly. This increases the level of aggregate demand, which will send a signal to businesses to increase rates of production, increasing economic growth. To achieve an increased rate of production, this will increase the demand for labor and decrease the unemployment rate. However, one weakness of using budgetary policy to achieve jobs and growth is that there can be long implementation lags before budgetary policies are enacted, as they need to be voted on through both houses of Parliament. This can greatly delay the impact of new policies can have on the rate of economic growth and the rate of unemployment, and therefore makes it difficult to achieve them in the short term. So that's for both of them, really stating what that strength and weakness is and giving detail about how that links to jobs and growth. So you get 2 marks for each of those. Then we do the same for monetary policy on this next slide. So monetary policy is an aggregate demand management tool involving the RBA manipulating the cash rate and therefore influencing interest rates. One strength of using monetary policy to achieve increased jobs and growth is that monetary policy has a short implementation lag. That means that when the RBA announces a decrease in the cash rate, this can flow on to reduce interest rates from financial institutions within 24 hours. This means that households and businesses with variable rate loans can now pay less on borrowed funds and are more likely to conduct private consumption spending and private investment spending to stimulate aggregate demand. Then we've got this increases the level of aggregate demand and will send a signal to businesses to increase rates of production, increasing economic growth. To achieve this increased rate of production, there's increase the demand for labour and decreases the unemployment rate. So there's covering your jobs and growth. However, one weakness in monetary policy is that it's not as effective as stimulating economic activity in a downturn or when consumer confidence is low. So there's your weakness there stated. This means that consumers are unlikely to borrow funds from financial institutions regardless of how low interest rates are set, as they are not confident about being able to repay them in the future. This means that they will not be as effective at increasing aggregate demand as households choose to save rather than spend, and therefore will be limited impact on economic growth and the rate of unemployment. So there you go for that one, covering both of them, a really clear strength and weakness about how they can or cannot help to achieve jobs and growth. And that's essentially it for 2 different 8-mark questions. Thank you for watching this. If you have any other requests of what you'd like in terms of preparation for your exam, which is now less than 3 weeks away, let me know, leave a comment below or email me, sean@therunningeconomy.com. If there's any content at all you want in the lead up to the exam or any questions you have, do not hesitate to ask. Other than that, I hope you are having a wonderful day preparing for your English exam, and I will talk to you next time. Bye.